Look at this chart. In a single day, the S&P 500 dropped 3%, the Dow lost 2.6%, and the Nasdaq slipped 3.4%. It was the steepest one-day decline in nearly 2 years. Instantly, social media feeds filled with investors declaring they were selling everything to get out of the market. When you see screens glowing red across the board, the biological response is to cut your losses and run. But selling during a sudden drop locks in your losses. A lower number on your screen becomes permanent financial damage the moment you hit sell. This raises a critical question. Are we watching the early stages of a systemic collapse, or are investors misreading the economic dashboard? To figure out what's really happening, we have to mute the doomsday headlines. 4 specific, simultaneous triggers combined to break the market's momentum. The first trigger was the July jobs report. The U.S. added 114,000 jobs, well below the expected 150,000, and unemployment ticked up to 4.3%. That's not a disaster, but it tripped a wire known as the SOM rule. This graph tracks the SOM rule. It triggers when the 3-month average unemployment rate rises by at least 0.5% from its lowest point in the previous year. Investors track this metric because it has flagged every U.S. recession since World War II. Yet even Claudia Sahm, the economist who created the rule, suggests it might be a false alarm this time. Unemployment is rising because a larger number of people are entering the workforce and looking for jobs, rather than companies executing mass layoffs. Major retailers report that consumer spending is slowing down, which warrants attention. However, the core labor data shows an expanding workforce, which contradicts the typical recession narrative. The second major anxiety comes straight from the Federal Reserve. They recently hinted that they would soon begin cutting interest rates. Historically, when the Fed slashes rates from a peak, a recession follows close behind. In the past, those rate cuts were emergency maneuvers. The Fed was forced to slam on the brakes to save an economy that was shrinking. The Fed hiked rates to combat a 9.1% inflation spike in 2022. They're cutting rates now because inflation is approaching their 2% target. Lower rates make borrowing cheaper, injecting cash into the system and spurring economic growth. The upcoming rate cuts signal that the Fed has successfully contained the post-pandemic inflation crisis. This pie chart illustrates our third trigger. The Magnificent 7 tech companies make up 31% of the entire S&P 500 index. Because the index is so top-heavy, the recent volatility in these specific tech giants dragged the entire market down. For the past year, relentless hype surrounding artificial intelligence pushed the valuations of these companies to heights that defied basic math. The market priced them for absolute perfection. Then came the reality check. NVIDIA announced delays for its highly anticipated Blackwell chips, and Apple's early AI previews failed to meet expectations. This forced stock prices to adjust to a more realistic outlook. Experienced investors saw this coming. Major players like Warren Buffett's Berkshire Hathaway slashed their stakes in companies like Apple by nearly 50%. We are witnessing a correction, a return to mathematically sound pricing after months of speculative AI hype. Investors used the carry trade, borrowing Japanese yen at zero interest and multiplying their money by investing it in high-yield U.S. assets. This strategy worked for years, right up until the Bank of Japan unexpectedly raised its main interest rate. Almost overnight, the value of the yen spiked. Traders who borrowed heavily in yen suddenly found their debt exploding in value. To cover these massive, unexpected margins, they were forced into a global fire sale, liquidating their U.S. stocks immediately. The market plunge stemmed from a mechanical glitch in global currency trading, rather than a structural failure within the U.S. economy. When we clear away the AI corrections and the foreign currency liquidations, the actual data tells a different story. The U.S. economy remains productive, and the S&P 500 is still up significantly this year. A drop of 10. By investing a set amount of money at regular intervals, you are systematically buying shares at a discount as the price drops. But there is a strict requirement to play this safely. You must hold an emergency cash fund covering 3 to 5 months of living expenses. This ensures you are never forced to sell your depreciated stock just to cover your costs. Real generational wealth is built by diversifying your assets, holding steady through the turbulence, and capitalizing on the market's moments of irrational fear.